the combined open interest of the silver contract, the Comex contract, going back to 2006. And you can kind of see we've been in this upward channel, kind of defined by the two black lines, where you had open interest growing, volume activity was growing. It was a healthy environment for the futures market, and that tend to sort of control prices, I guess you could say, or have influence on the prices. Interesting enough, March of 2020 came along. Here comes COVID. Here's this big drop in the open interest. And then all of a sudden you had this bounce back up to get back into the channel. And then that just kind of wavered and floundered. And as we try to jet back into the channel, it couldn't get back into it and eventually collapsed. Mm-hmm. If this was a stock, this wouldn't be a really good looking chart. And so for me, this is it's interesting because a lot of people say, well, okay, you had margin interest rates or margin requirements go up during that time frame, and that may have had influence on the number of contracts. But this is during the same time you had 50 million ounces come onto the registered category. People putting metal onto the exchange and playing the sort of arb game of collecting spreads and premiums and arbitrage. And so it did make a lot of sense while you just saw a complete collapse in activity. But you did have the silver market. You saw the deleveraging where you had the number of ounces, the physical. Paper ounces to physical ounces. Back in 2016, it was 300 to 1, and now it's down to like 7 to 1. I mean, it's really come down because of all the ounces that have come on to the market. And of course, this last since COVID broke out, you had about 95 million ounces before COVID in the registered category, went to about 150 million. Now you just broken back under 100 million ounces that are held in the registered category. So that's demand that's coming out of the market and going into fabrication, minting, that type of thing. Mm-hmm. And this is where I start to tie in what it all means. Is here is a chart with, it's basically the percentage change of the combined open interest as well as for futures, and then in orange, and then you have combined open interest for futures and options in purple. And this is just, again, percentage changes, but you can kind of see this big circle here post-COVID. The price in silver is in blue, and you can see that the open interest in both options and futures has been in sharp decline, even as the price has come out of a big dip in March of 2020, and then just basically oscillating or stabilizing in the 20s, just kind of bouncing back and forth. What I try to do here is I looked at a point in time that was very similar in conditions where you had a massive deleveraging, you had a bounce back in price, and then some type of stabilization price. But at the same time, you had futures and options activity start to decline again. And the reason why I look at that is the futures, if you have open interest in steady decline, that's typically, in most cases, the long activity is being blown out of the market or just losing interest. And the shorts at that point tend to be more of a dominant role. So when the roll comes, when you have to buy back a contract or roll out of your position into the next futures contract, the next lead month contract, you want to see what type of effect could happen off of that, whether it's if it's the longs that need to roll out of the position and they're more aggressive. When they sell their long position in the front month contract and roll forward to for the next contract, that roll period, they may have more of an impact on the front month contract and push prices down. Whereas if it was the exact opposite and the shorts needed to get out of the contract, like what happened in March of 2020 when you had a shutdown, and you had logistics failures, and you had mining operations shut down, and banks tried to get out of their positions in March, like with gold, and all of a sudden they couldn't because there was no liquidity because all the longs got blown out, 2 weeks prior because of the COVID event. So when they tried to get out, they basically they had to buy back at any price. Well, that's when the price and the spreads blew out between New York and London. Well, looking at all that, I go back to 2008, and here you see this big deleveraging event. Contracts implode. You have the price start to spike up, and then you had open interest start to rise again, and then all of a sudden you got this sort of flagging pattern again, where silver goes into the 20s, and yet open interest starts to decline again. And what I wanted to look at was, okay, if open interest is a lot lighter, and so shorts, maybe the short interest is now trying to take advantage of the roll, or they're hedging their production, whatever it may be. What happens if the price doesn't go down, and it starts to rise? And then here you kind of saw this dominant force of shorts being squeezed and the price starting to take off again. To kind of put this in perspective, this is a little bit more of a snapshot of post-COVID, March 2020. It's kind of maybe hard to see, but you have this gray line here where you have the price spike down, and you can kind of see where the physical market, this is showing ETFs and fund flows, which I know what I just said was it doesn't have much effect on price, but the physical market, the direct physical market, also came alive during the same time. So it wasn't just metal going into ETFs. It was a lot of buying pressure on the retail side for product, as well as 1,000-ounce bars. Well, that big drawdown in price created a lot of long liquidation in the futures market. You saw that with the open interest coming down. And then with the surge in physical demand, you started to see the price start to rise back up here. And then, of course, we know that the premium started to blow out actually on silver as well, where you had that same thing happen in the gold market. Just a short time later, the silver market saw that similar blowout between New York Comex prices.
Mm-hmm. Bob, would you mind just describing the price chart there for us, because it's really hard to see on that chart?
Yeah, it's just this gray line right here of silver. I know it's kind of hard to see. It may not be, maybe a little bit faint here, but it was just basically showing right at this point right here where the price started to collapse. You saw a lot of physical metal starting to be bought, and as that started happening, that started to anyone who was short the market either had to deliver their contract or deliver against their contract if they own the metal, or they had to roll out and buy that contract back and maybe short the next lead month contract. What happened during that March 2020 timeframe was you had mines shut down, you had everything basically stop, and so you didn't have you had this concern that if you had metal and you didn't want to get rid of it, or you were just hedging on paper and you couldn't actually deliver metal because it just wasn't even available in London, you had to cover that contract back, and that's what put a lot of pressure on the Comex side, and that's where spreads really started to blow out, and Comex prices were a lot higher than London prices.
So at that time, physical demand was really driving the price.
Right, exactly. And that's this deleveraging that I see unfolding here, because since that time frame, I mean, you had a lot of metal come onto the market, and refiners and other users of metal started putting metal onto the market during that time frame and started saying, hey, listen, I'm going to take advantage of this massive spread between London prices and New York prices, and I'm going to put the metal on the Comex, sell the futures contract against the existing metal that I already have. Got to play the same game that the banks and other hedge funds play, which is on spreads. But the users of metal got to use their own metal as collateral to do this with. And then also you had the issue with London and so forth with collateral financing. So it was easier to move metal onto the exchange and borrow against that metal because it was on receipt. It was secure. It was you had more transparency if you were a lender against that metal. So there was other advantages too. This was an interesting thing that I brought up. Another form of deleveraging that we saw. This is the gold contract. 2015, late 2015, actually, I think the day the Fed raised rates or the day after, gold had bottomed around 2000 or 1050. But what was interesting was in January of 2016, about a month after that, the gold backing the registered, or sorry, gold in the registered category, which backed the futures contracts, got down to a low of 73, a little bit below 74,000 ounces. That represented, or basically backed all the futures contracts that were open at the time. That was where you had basically a 300-to-1 leverage effect on paper ounces to actual physical ounces backing that. And fast forward to today, that number is now below 3-to-1 because you have about 18 or so million ounces in the registered category. I think it's 17 million something now at this point. But you've had this massive deleveraging of again, physical coming onto the exchange, and you don't have the margin or the borrowing against or leverage of these paper contracts being used as frequently as they used to. Mm-hmm. So what that tends for me to believe is that I don't think you're going to see this massive drop like we saw in 2013, for example, where you have the gold market go from 1,700 down to 1,050 or so. I don't think we're going to see that because you don't have the contracts out there in the open market, amongst all the longs that are susceptible to that sell-off. The forced selling that kind of comes into that.
Basically, we're much closer to a bottom than we are a top from this open interest standpoint, right?
Yeah, that's what I would tend to believe. And you start to see this when you start using other tools like sentiment measures. You see that with you see it with the bullish percentile, for example. With this is actually the bullish percentile for gold miners, for example, the bullish percentage or percent index, and you can kind of see that we're at 16.67 right now, which on a scale of 0 to 100, 0 being everyone wants to give this stuff away and they can't even do that, to 100% saying that this is the greatest thing since like